What's up, guys? Welcome to another Market Radar podcast. Let's kick it off with the year-to-date performances. We've got SPY down 17.67%, QQQ down 29.78%, IWM down 20.73%, and DIA down 8.29%. Dow Jones is the only one that's bullish trend still, but we did see quite a large pullback recently, closer down to Momo. So we'll see how that develops. Based on our regime model, we're still in stagflation, still risk off. It's not looking good for risk equities. So we are still fully expecting a continuation of bearish trends. Going into next week, the main days we're looking for is Tuesday and Wednesday, where we've got CPI on Tuesday and we've got FOMC on Wednesday. Those are going to be the big days to look out for.
Let's bring up Aries here. So this is our leveraged balls deep portfolio, and the signals for Aries are provided in the weather report, updated daily. So for the subscribers that are watching, you can see that information there every day. And let's go over PPI because that was the big report this last week. We saw the readings come down on year-over-year prints at 7.4 over the prior 8% print. The estimate was actually for 7.2, so the year-over-year print did come in higher than expected in the last reading. Nonetheless, though, this is showing that inflation overall is slowing, right? This is off its highs on the year-over-year, slowing, coming in on a percentage change basis, but we're still a far ways from where the we saw this trade or printing on a normal basis here, between anywhere from under or above -2 to under 4. So this again is still out there in terms of inflation readings. And ES did a whole lot of nothing this week. I mean, well, compared to what it's been doing in the prior weeks, we closed down 2.68%, but we haven't really gone anywhere in the last month. I guess that's what I should say, right? It's the last month.
Yeah, pretty much markets waiting for the Fed. We're essentially in that stalemate position where we're really not expecting any significant direction until FOMC next week.
Right. And until that happens, markets can and most likely will continue to chop. Now, bonds, on the other hand, bonds are off their lows for their 52-week lows in the last month or so. We've seen the bond rally take place here. Now, what is this telling us? Long story short, it's telling us that the bond buyers are getting bearish on inflation rather aggressively, rather quickly. Now, this isn't to say that this is the start of the next super cycle move in bonds higher, right? This is just to say that people are expecting rates to come down, which they have with bonds going up, and potentially chop sideways given the trend, right? We have been saying this for weeks now. 4 weeks, maybe even months. Until the bonds go bullish trend, this is not the buy. This is not the buy for us. It's not. We're going to get caught chopping sideways if we decide to long now. We've seen this happen, this type of move. Now, obviously, this move's a bit more aggressive and linear than it was over here, but it's the same type of action, right? Bonds come off their lows, everyone gets hyped up, and then what? Listen, there's a macro thesis for anything, right? You could say, listen, deflation next year, CPI is going to fall apart. You can read a fucking fairy tale book. It doesn't really matter until the price action starts to show it, right? This is the importance of our system and DDAP, because when you put them together, we get the Aries system, right? And the Aries system is built off of those two counterbalancing, or I should say, balancing things. If you just have one direction, one opinion, or one signal, you're most likely going to get fucked over time. And that's what happened to a lot of bond bulls in the last, let's call it 8 to 9 months. Everyone's been trying to chase this dip lower.
Well, yeah, because everyone's used to the whole 60-40 mentality. If equities are doing shit, that means bonds are the play.
Right.
But that's not the reality. You gotta have a system like what we have, which catches itself. We don't get faked out. We don't get faked
Oh,
out, and that's why we can go balls deep every time we go in. That's how we get that 30% compounded annual growth rate that you see on the Ares portfolio, because we have confidence to go in with leverage every single time.
right. And long story short, if you look at bonds, we got the bearish trend signal on DDAP back in August of 2020. Since then, it shit the bed. But if you want to take the micro approach to it, you could say, oh, look at these rallies, right? Yeah, these rallies looked real great until new lows are printed. And this is not me saying that, oh, the bond lows are not in, we're going to go lower, because matter of fact, in November or late October, early November, we came out explicitly saying that the move lower in bonds was or had a lower risk to reward ratio, right? The rewards for, or I should say, the payout for lower bond prices and higher yields just wasn't there. We're having to move up, but that doesn't mean we went long bonds. That's just us saying that, look, bonds have come down so much, yields have risen so much in such a short period of time that at some point you're going to hit a fulcrum where, like, yeah, okay, it makes sense that bonds are not going to just go in a straight line down forever. There's going to be a bounce. But the question is, are you caught in the bounce here, buying and chopping sideways? And we actually had a few people hit us up on Twitter about this, saying, like, it's not, because we assimilate this type of chop with dead capital, because to us it is. When you're dealing with leverage, chop is dead capital. Now, obviously, people are like, oh, the coupon, all this shit. Yeah, that's good. The coupon's great, but what good is the coupon if the bond isn't actually moved, right? Because unless you're buying bonds for a special reason to diversify for a certain percentage of your portfolio, what do you really give a shit about the coupon for?
Yeah,
Like,
we're not long-term bond investors here. We're here to make money. We're here to
right.
lever up.
Yeah. And like the move, and let's just take TLT, for example, right? Let's look at TLT. And you notice how TLT has had these bullish trend triggers in between, and which is why we use futures. They're more liquid and more direct. And that's why none of these bullish trends were realized on our system, because this again is individual ETF, less liquid, less price history, and just less trading on a 24-hour basis. So that's why we use futures. Regardless, though, the move in bonds is great if you're capturing a 2% coupon. Eventually, this coupon will rise given the current yield, whatever, yada. You can give your fundamental bullshit, right? Yada yada. But then the real move in here is like if TLT can go back to like 150, 160, right? That's what we're looking for. It's like fuck the 4%, 5% Warren Buffett bullshit. Like we're looking to catch this move from 106, 109 to like 150, 160. The best part about that is she ain't going from 106 to 160 with our dicks in our hands. Okay? She's going to trigger bullish trend, right? She's going to have to go above Momo, flip trend. We're most likely going to see the deflationary regime there, and then the move happens.
Right. And likely before that happens, very likely we're probably going to get chop for a few months.
Right.
We're going to get chop. Momo's going to come down probably to the 135, 130s area. And then that's when we'll get the trigger. If we were to get a deflationary pivot, that's likely how it will play out. That's usually how it works.
Yeah. And I just pulled up real yields on the screen. For those that don't know what this is simply the yield on a 10-year bond after accounting for the expected break-even inflation rate over that duration. So the yield minus the expected inflation rate gives you the real return after inflation. So back at the beginning of the year, when this was printing -1, we were here adamantly saying this was going to go higher. Literally. I mean, we pounded the table on it, and this thing went fucking parabolic, right? Well, for your bond trade or the bond trade itself to work out, this has to shit the bed.
Right. And now we're actually in an environment where that is possible. Whereas back at the start of the year, everyone longing bonds, calling for deflation, real yields were -1 territory. And people were calling deflation back then. We came out and said, this is not the environment for deflation. We literally cannot get deflation in this environment. Sure enough, we did not. Bonds shat the bed. Now we're in a situation where deflation is possible. We're still not, our system is still not hinting that. but we are
Right.
in an environment where it is possible.
Yes, and you know the best analogy for this is think of a seesaw, right, at a playground, and think of the odds of deflation just being grounded over years. Like it's not going to happen, right? And that seesaw is tilted one way. Where we are right now, the seesaw is more evenly balanced. It's not fully in deflation. We're not in deflation, but the odds have now shifted to the point of where that seesaw can like balance a bit. Now we could start tilting. We could start actually moving into that deflationary territory. But again, we're not there yet. Like Artie just said, our system is not pointing there. And we are also, though, not in an environment where deflation is no longer a conceivable probability. So that's something that we have to pay attention to, and we have been. Obviously, our big concern with this whole bond move off the lows is not, oh, is this bond move going to stick? It's how much chop is going to have to happen before I can get that trigger. Because chop on something like TMF will burn the shit out of you. It will. 3 months of chop on this is not going to be fun.
Right.
And
There is a time decay component in that.
yes, yes, and that's something that we have to be careful for because we don't want to get caught, sitting and basically going sideways and getting our position eroded while the move isn't going to take place because it becomes an issue when your whole account is in. Okay, like just remember we might have missed the lows here. We might have missed the lows here. Like, okay, let's go back in time. When ZB was here, oh, yeah, everyone was saying the bonds are done. Excuse me, rates have peaked, whatever, the whole inflation bullshit, yada, yada, yada. We missed the move. And then sure enough, shit the bed, right? Now, maybe this time, this was the low. Maybe bonds will chop higher. But when you're dealing with full, like balls deep in your portfolio, like you do not want to see some non-confirmatory shit. Like you want to make sure the wind is in your sails. If it's not, then you can't go full port. You just can't do it.
Yeah. And
And that's
if you can't go full port, you don't get the full compounding effect that our Aries portfolio gets.
right. And the one reason why you can't go full port is there's no conviction here. For Aries to work, for this to work, this was all high conviction trades that have been mapped out, cookie cutter, black and white. The system had to for this to happen. There is no nuance. There is no feelings. There's no tingling in the nuts. Okay, this was literally X and Y have to happen combined at the same time for the signal to occur. If not, the signal didn't exist, or the signal didn't occur. The portfolio stayed flat, or didn't act in that manner at that time. And literally, that is what we are waiting for right now. We're waiting for the Aries trigger and to start swinging the bat. And I think we should also go over liquidity because this is again another big talking point in the markets. Everyone's saying you have one camp of people saying that the Fed has the ability to flush the market with liquidity with this reverse repo thing, where the reverse repo levels are in the trillions, and this idea that the Fed can just unload reverse repo into the market and feed the market. We've went over that multiple times. It's a bunch of bullshit. Long story short, money is sidelined. Cash is sidelined. Trillions of dollars is sidelined. And the liquidity risk index that we follow, it's our proprietary index, is indicating that as well. We're having that print in it's been printing between 100 and 110, which is here on the chart. We are under the prior peak of the year and the 2020 peak. So again, some improvements, just like the real yields, right? Like this is looking a lot better now for that deflationary situation where cash can start flushing back into the market. But and when I say cash flushing into the market, I mean cash flushing into bonds, right? Because at the moment, the equities situation is not looking too hot, but we'll see how that progresses. Long story short, liquidity is not favorable. It's quite a bit away from being favorable for equities as a whole. I mean, anything under 70 on the liquidity risk index is seen as good for a good equity environment. But we do expect to see this break lower with a pivot to deflation. So the fact that this is still chopping sideways, I mean, it's giving us the feeling that stagflation may be here for a little bit longer, which lines up with our sideways chopping bond thesis. And finally, let's talk about the Fed forecaster. We are back under a 5% terminal, which is interesting, right? We were all the way up to a 5.25. This thing's been all over the place this year, chugging higher, coming back, chugging high. It's kind of been like one of those stair stepper things where you push up, come back a little bit, push up, come back a little bit, and we were at like under four, mid four, low fours, mid fours, high fours, fives, so on and so forth. Now we're back to fours.
It's really looking like it's stabilizing around 5.
Yes, and the question now is, are we going to see this thing really fall apart like it's saying here, like it will, or are we going to see um, some different type of action, maybe in a more I should say swift decline, or an actual issue with inflation where this has to not only stay sideways but go higher. And we're going to start to see that unfold in the next few meetings because remember, this is based off of Fed meetings here. Now, the question is going to be at these meetings when the Fed enacts this policy going up into these meetings, what's the inflation what are the inflation expectations doing? Aka, real yields, the bond market, the whole nine. What are they doing and how are they signaling the future at that point in time? Right now, we're signaling a peak in May and then slow decline, and then it picks up slow. It picks up quite aggressively at the end of 2023, bringing us early 2023. Excuse me, early 2024 or late 2023 down to 4.5%. So all you need to know is where we are in 2024 is still higher than where we are today.
Yeah, so higher rates for longer. That's what to
Yep.
expect.
That's exactly what to expect. But I think that's where we'll cut it off here. If you have any questions, you can reach out to us in our Discord. The link to join our Discord is on our website at market-radar.com. And you can also reach out to us on Twitter at the Market Radar. Thank you so much, guys, for listening and have a great week.